The new pension rules that were passed by Congress in 2022 and 2023 have some important implications for established and minority investors. In this section, we will explain how these rules affect different groups of investors differently and what you can do to equip yourself for the changes. One of the major changes in the new pension rules is the increase in the age for required minimum distributions, RMDs, from retirement accounts like 401k plans and IRAs. RMDs are the minimum amount that you must withdraw from your retirement account each year once you reach a certain age. The new rules raise the age for RMDs from 72 to 73 starting in 2023, and then further to 75 starting in. This means that you can defer taxes on your retirement savings for longer and let them grow more. This change benefits established investors who have large retirement balances and do not need to withdraw money from their accounts to meet their living expenses. By delaying RMDs, they can reduce their tax burden and preserve their wealth for longer. However, this change may not benefit minority investors who have lower retirement balances and may need to withdraw money from their accounts sooner to cover their needs. For them, delaying RMDs may not make much difference in their tax situation and may even increase their tax rate if they have other sources of income. Another significant change in the new pension rules is the increase in the catch-up contribution limits for older workers. Catch-up contributions are the extra amount that you can contribute to your retirement account each year over the standard limit if you are 50 or older. The new rules boost the catch-up limit for workers over 50 and introduce an additional catch-up contribution for workers over starting in 2024. Instead of a flat $1,000 more, workers over 50 will be able to contribute an additional amount that is indexed to inflation. And starting in 2025, workers aged 60 to 63 will be able to contribute up to $10,000 per year or 50% more, whichever is greater, than the standard catch-up contribution. For those over this change benefits both established and minority investors who are still working and want to save more for retirement. By increasing the catch-up contribution limits, they can take advantage of the tax benefits of retirement accounts and boost their retirement income. However, this change may benefit established investors more than minority investors because they may have more disposable income and more access to workplace retirement plans that allow catch-up contributions. A third notable change in the new pension rules is the requirement for auto-enrollment in 401k plans for most employers starting new workplace retirement savings plans after December 31st. Auto-enrollment means that employees are automatically enrolled in the plan unless they opt out. The new rules also require employers to set a default contribution rate of at least 3% but not more than 10% for the employee, plus an automatic contribution escalation of 1% per year up to a maximum contribution rate of at least 10% but not more than 15%. This change benefits minority investors who may not have participated in a workplace retirement plan before or who may have contributed less than they could afford. By automatically enrolling them in the plan and increasing their contribution rate over time, they can increase their retirement savings and benefit from employer matching contributions if available. However, this change may not benefit established investors who already have sufficient retirement savings and may prefer to invest their money elsewhere. For them, auto-enrollment may be an inconvenience and a loss of control over their financial decisions. These are some of the ways that the new pension rules affect established and minority investors differently. To equip yourself for these changes, you should review your retirement goals and strategies and adjust them accordingly. You should also consult a financial planner or a tax advisor if you have any questions or concerns about how these changes affect your specific situation. The new pension rules that will take effect from April 2023 will have a significant impact on how you can save for your retirement. In this section, we will discuss some of the best strategies to maximize your pension savings under the new rules. One of the biggest changes is the increase in the tax-free pension limits. Currently, the most you can normally save into private pension pots in one tax year before you start paying tax is £40. This is known as the pension's annual allowance. The government has confirmed that this allowance will rise by £20,000 to £60,000 from April 6. This means that you will be able to save more money into your pension without paying any tax on it. This is especially beneficial if you are a higher or additional rate taxpayer, as you can get up to 45% tax relief on your pension contributions. For example, if you earn £100,000 and contribute £60,000 to your pension in 2023/24, you will only pay tax on £40,000 of your income, saving you £9,000 in tax. Another change is the extension of the age for required minimum distributions, RMDs, from your pension. RMDs are the minimum amount that you must withdraw from your pension each year once you reach a certain age. Currently, you must start taking RMDs from your 401k and IRA accounts starting at age 72, or 70 and a half if you turned that age before Jan. 1, 2020. The Secure 2.0 Act of 2022 raises the age for RMDs to 73, starting on Jan. 1, 2023, and then further to 75, starting on Jan. 1. This means that you will have more time to let your pension grow tax-deferred before you have to start taking money out of it. This can help you preserve your retirement income and reduce your tax liability in later years. For example, if you have a $500,000 pension and withdraw 4% of it each year, delaying your RMDs by 1 year will save you $20,000 in withdrawals and $5,000 in taxes, assuming a 25% tax rate. A third change is the increase in the catch-up contribution limits for older savers. Catch-up contributions are additional amounts that you can contribute to your retirement accounts each year over the standard limit if you are over a certain age. IRS law currently allows people 50 and up to contribute an additional $1,000 to their retirement accounts each year over the standard limit. Starting in 2024, instead of a flat $1,000 more, older Americans will be able to contribute an additional amount that is indexed to inflation. Moreover, for people aged 60 to 63, they will soon be able to contribute even more catch-up money. In 2025, those seniors will be allowed to contribute up to $10,000 per year or 50% more, whichever is greater, than the standard catch-up contribution for those 50 and up. These increased contribution limits will also be indexed with inflation starting, and this means that you will be able to boost your retirement savings by putting more money into your pension accounts if you are over 50 or over. This can help you make up for any shortfall in your pension savings or take advantage of higher tax relief if you are in a higher income bracket. For example, if you are 60 years old and earn $100,000 in 2025, you will be able to contribute up to $29,500 to your IRA, $19,500 standard limit plus $10,000 catch-up limit, saving you $7,375 in taxes, assuming a 25% tax rate. These are some of the best strategies to maximize your pension savings under the new rules that will take effect from April. By taking advantage of these changes, you can increase your retirement income and reduce your tax burden in the future.